Today's topic is individual market sectors. Alright, so, for a while I've been proposing to myself that I should make videos on each of the individual market sectors. This, right here, is the result of that proposed idea. Voila! However, instead of single videos, I will cram it all together in one or two large videos. To begin, much like a previous video I created, which introduces the different 11 market sectors, I have found a more recent Investopedia article introducing the same 11 sectors. So, I'll start by copying and pasting that into the text-to-speech reader. Here it is. Note to self, to include timestamps as a table of contents. See links below. Sector breakdown definition and stock market use. By Adam Hayes, updated February 23, 2022. Reviewed by Gordon Scott. Fact-checked by Yarole Porres. Sector breakdown. Investopedia/Eliana Rogers. What is a sector breakdown? A sector breakdown is the mix of sectors within a fund or portfolio, typically expressed as a portfolio percentage. Sector designations can vary depending on the fund's investment criteria and overall objective. Key takeaways. The sector breakdown of a portfolio shows how much asset weights are allocated to what industry sectors. Sectors typically are considered to be broad classifications such as manufacturing, financial, or technology. Within each sector, numerous subsectors and industries can be further delineated. A well-diversified portfolio should not have too many investments concentrated in a single sector or group of related sectors. Understanding sector breakdown. A sector breakdown is provided for fund analysis and can help an investor to observe the investment allocations of a fund. Sector investing can be a significant factor in influencing investments in the fund. A fund may target a specific sector, seek to diversify among sectors, or generally have sector variance that results from investing from a broad universe. A sector fund would have an allocation of 100% to a specified sector. Some funds may have restraints on sector investments. Therefore, fund analysis is used by fund managers to exclude specific investments. This often occurs with environmental, social, and governance, ESG, focused funds. These funds seek to exclude industries or companies that their investors consider undesirable for various reasons. This may include an industry grouping such as tobacco producers in one fund, or oil exploration companies in another fund. Fund companies regularly provide sector reporting in their marketing materials. Sector breakdowns provide a representation of the sector allocations of the fund's assets, often on a monthly or quarterly basis. Some funds may even report sector breakdowns daily on the fund's website. GICS sectors. Sectors are typically considered to be a broad classification. Within each sector, numerous subsectors and industries can also be further delineated. The Global Industry Classification Standard, also known as GICS, is the primary financial industry standard for defining sector classifications. 1. The Global Industry Classification Standard was developed by index providers MSCI and the S&P Dow Jones. Its hierarchy begins with 11 sectors, which can be further delineated to 24 industry groups, 69 industries, and 158 sub-industries. It follows a coding system that assigns a code from each grouping to every company publicly traded in the market. The GICS coding system is integrated throughout the industry, allowing for detailed reporting and stock screening through financial technology. 2. The 11 broad GICS sectors commonly used for sector breakdown reporting include the following. 3. Energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, real estate. Diversification and sectors. A diversified stock portfolio will hold stocks across most, if not all, GICS sectors. Diversification across stock sectors helps to mitigate idiosyncratic or unsystematic risks caused by factors affecting specific industries or companies within an industry. Sector indexes can also be used by investors seeking to invest in the growth prospects of a single sector. Investment companies offer passive index funds that seek to replicate each of the 11 GICS sectors. The Vanguard Information Technology Index Fund is one example of a passively managed mutual fund that seeks to replicate the holdings of the MSCI US Investable Market Information Technology Index. The strategy is also available to investors through an exchange-traded fund, the Vanguard Information Technology ETF. 4. What is a good sector breakdown for a portfolio? A well-diversified portfolio should have access to as many sectors as possible, and not concentrate too many funds into any single sector or related sectors. You may also want to apply the 5% rule with sector funds. For example, if you wanted to diversify within specialty sectors, such as biotech, commercial real estate, or gold miners, you simply keep your allocation to 5% or less for each. What are the major industry sectors? These range from utilities to consumer staples to technology. The 11 GICS recognized industry sectors are listed above. The GICS subdivides this into 24 industry groups such as automobiles, banks, and apparel companies. 5. What is the sector breakdown of the S&P 500 index? As of Jan. 31, 2022, the sector breakdown of the S&P 500 is 6. Information technology, 28.7%. Healthcare, 13.1%. Consumer discretionary, 12%. Financials, 11.3%. Communication services, 10%. Industrials, 7.8%. Consumer staples, 6.1%. Energy, 3.4%. Real estate, 2.7%. Materials, 2.5%. Utilities, 2.5%. Okay, me again, well, that may have been redundant. Now, I'll begin the process of providing articles for each of the 11 sectors. I'll use the aforementioned list. So, information technology is the first sector of study. Stocks. Tech stocks. Technology sector, definition, 4 major sectors, investing in tech. By Jake Frank Enfield, updated January 2, 2022. Reviewed by Gordon Scott. Fact-checked by Yarole Porres. What is the technology sector? The technology sector is the category of stocks relating to the research, development, or distribution of technologically based goods and services. This sector contains businesses revolving around the manufacturing of electronics, creation of software, computers, or products and services relating to information technology. The technology sector offers a wide range of products and services for both customers and other businesses. Consumer goods like personal computers, mobile devices, wearable technology, home appliances, televisions, and so on are continually being improved and sold to consumers with new features. On the business side, companies are dependent on innovations coming out of the technology sector to create their enterprise software, manage their logistics systems, protect their databases, and generally provide the critical information and services that allow companies to make strategic business decisions. The term technology sector is frequently shortened to tech sector and is used interchangeably with the term technology industry. Key takeaways. The technology sector is comprised of businesses that sell goods and services in electronics, software, computers, artificial intelligence, and other industries related to information technology, IT. Tech companies invest heavily in research and development and may undertake riskier projects with greater future potential. Tech companies run social media platforms like Facebook, Twitter, and Instagram. Companies rely on the technology sector to help them grow and thrive. The technology sector is often one of the most attractive growth investments in an economy. Understanding the technology sector. The technology sector is often the most attractive investment destination in any economy. The U.S. technology sector boasts of companies like Apple, Google, Amazon, Meta, formerly Facebook, Netflix, IBM, and Microsoft. These companies drive the growth in the tech sector, and the enthusiasm around their long-term potential has them trading at price-to-earnings multiples that look ridiculous compared to almost every other sector. A large amount of this growth owes a debt to the buzz factor that technology companies seem to effortlessly create by launching whole new business lines that have never existed before. Growth in the technology sector. The term technology sector has been broadened many times to include businesses that may be better served by a more specific category. The technology sector was initially anchored in semiconductors, computing hardware, and communications equipment. In addition, growth also includes jobs. According to the U.S. Bureau of Labor Statistics, jobs in computer and information technology are poised to grow 13% between 2020 and 2030. 1. The addition of software companies expanded the perceived tech sector to include anything based on coding. Soon, more room had to be made for internet companies, which flooded during the internet boom. Some of these internet companies were media and content companies that used code as the medium. Still, others were off launching rich features that grew to be e-commerce, social media, the sharing economy, and even cloud-based computing. The technology sector now includes such a diverse set of companies that the subsectors are far more useful than the overall one. Unsurprisingly, there is no universal agreement. Some pundits want a whole new sector for each innovation, but the big buckets include semiconductors, software, networking and internet, and hardware. From there, all the subsectors can be further broken down. For example, hardware breaks into wearables, peripherals, laptops, desktops, and so on. People may argue that it doesn't make sense to call a cloud computing company a software company, but the arbitrary separations are a bit more manageable than the massive label of tech sector for every company. Okay, 1 down, and 10 more to go. That concludes the tech sector article. I should mention, there are multiple articles to choose from, so my arbitrary choices shall suffice. Okay, next sector is healthcare. Fundamental analysis sectors and industries. Healthcare sector, industries defined and key statistics. By the Investopedia team. Updated October 31, 2021. Reviewed by Khadija Kardi. Fact-checked by Suzanne Kvilhaug. What is the healthcare sector? The healthcare sector consists of businesses that provide medical services, manufacture medical equipment or drugs, provide medical insurance, or otherwise facilitate the provision of healthcare to patients. Key takeaways. The healthcare sector consists of all businesses involved in the provision and coordination of medical and related goods and services. This sector enjoys some significant advantages in the U.S. but is also beset with several factors that present potential economic problems. The U.S. healthcare sector accounts for an outsized share of spending relative to health outcomes, which has led to uncertainties around politically driven reform of the industry. Understanding the healthcare sector. The healthcare sector is one of the largest and most complex in the U.S. economy, accounting for 18% of gross domestic product, GDP, in 2020. 1. The U.S. healthcare sector benefits from a strong system of medical research and development, in cooperation with the higher education system and the technology industry. The aging U.S. population and the advancing senescence of the baby boomer generation are driving ongoing strong demand in the healthcare sector. Economically, healthcare markets are marked by a few distinct factors. Government intervention in healthcare markets and activities is pervasive, in part due to some of these economic factors. Demand for healthcare services is highly price inelastic. Consumers and producers face inherent uncertainties regarding needs, outcomes, and the costs of services. Patients, providers, and other industry players possess widely asymmetric information and principal-agent problems are ubiquitous. Major barriers to entry exist in the form of professional licensure, regulation, intellectual property protections, specialized expertise, research and development costs, and natural economies of scale. Consumption, or non-consumption, and production of medical services can involve significant externalities, particularly regarding infectious diseases. Transactions costs are high in both the provision of care and the coordination of care. Industries within the healthcare sector. The healthcare sector contains a diverse array of industries, with activities ranging from research to manufacturing to facilities management. Drugs. Drug manufacturers can further be broken down into biotechnology firms, major pharmaceutical firms, and makers of generic drugs. The biotech industry consists of companies that engage in research and development to create new drugs, devices, and treatment methods. Many of these companies are small and lack dependable sources of revenue. Their market value may depend entirely on the expectation that a drug or treatment will gain regulatory approval, and FDA decisions or rulings in patent cases can lead to sharp, double-digit swings in share prices. Examples of larger biotech firms include Novo Nordisk, NVO, Regeneron, Reg, Alexion, ALXN, Vertex, VRTX, Gilead Sciences Inc., Guild, and Celgene Corp. CELG. Major pharmaceutical firms also engage in research and development but tend to focus more on manufacturing and marketing an existing portfolio of drugs than the typical biotech firm. These companies tend to have more dependable streams of revenue and a more diversified pipeline of drugs in the research and development stages, making them less dependent on make-or-break drug trials and their shares less volatile. Examples of major pharmaceutical firms include Johnson & Johnson, Roche, Pfizer, Eli Lilly, Novartis AG, GlaxoSmithKline, and AstraZeneca. Some pharmaceutical firms specialize in generic drugs, which are identical to name-brand drugs but no longer enjoy patent protection. As a result, there is often competition to manufacture identical drugs, leading to lower prices and thinner profit margins. An example of a generic drugs firm is Teva Pharmaceutical Industries Ltd. Medical equipment. Medical equipment makers range from firms that manufacture standard, familiar products, scalpels, forceps, bandages, and gloves to those that conduct cutting-edge research and produce expensive, high-tech equipment, such as MRI machines and surgical robots. Medtronic plc is an example of a medical equipment maker. Managed healthcare. Managed healthcare companies provide health insurance policies. The big five firms that dominate the managed Medicaid industry are United Health Group Incorporated, Anthem Incorporated, Aetna Incorporated, Molina, and Centene. 2. Healthcare facilities. Healthcare facilities firms operate hospitals, clinics, labs, psychiatric facilities, and nursing homes. Examples include Laboratory Corp. of America Holdings, which operates facilities that perform blood tests and other analyses, and HCA Healthcare Incorporated, which operates hospitals and other healthcare facilities in the US and UK. Healthcare in the US and the OECD. According to the OECD, some of the highest quality care in the world can be found in the US, but in terms of some measures of health the US lags other wealthy, developed countries. Life expectancy is 78.9 years, according to the OECD, below the OECD average of 80. The OECD's 38 members are mostly rich, industrialized countries in Europe and North America. Despite these subpar results, the US spends far more than any other country on healthcare, measured per head of population, $10,948. This situation has led to a number of national reform efforts, including the Affordable Care Act. Investors in the healthcare sector face considerable political risk as a result of uncertainties around the push and pull between politics and industry interests. Okay, if you are paying attention, You'll notice that concludes the article on the healthcare sector. So, it's time for another exciting sector. Are you ready? Let's talk about the consumer discretionary sector. As you might expect, I also found a relevant article for that. Fundamental analysis sectors and industries. What is consumer discretionary? Definition in economic indicators. By the Investopedia team, updated January 22, 2023. Reviewed by Gordon Scott. What is consumer discretionary? Consumer discretionary is a term that describes goods and services that consumers consider non-essential but desirable if their available income is sufficient to purchase them. Examples of consumer discretionary products and services can include durable goods, high-end apparel, entertainment, leisure activities, and automobiles. Companies that supply these types of goods and services are usually either called consumer discretionaries or consumer cyclicals. The consumer discretionary sector of the economy encompasses various industries, the companies of which produce consumer discretionary products. Individuals can focus their investing on this sector by buying consumer discretionary stocks, mutual funds, and ETFs. Key takeaways. Consumer discretionary is an economic sector classification of non-essential consumer goods and services. The sector, its industries, and individual companies are watched by analysts and investors as an indicator of economic growth or slowdown. Consumers tend to spend more on consumer discretionary products in economic growth phases, when they may have more disposable income. Spending on consumer discretionary products slows in a weak economy. Consumer discretionary can be contrasted with consumer staples, which is a sector comprised of industries/companies that produce products essential to daily needs. Understanding consumer discretionary. The purchase of consumer discretionary products is often compared with the purchase of consumer staples. Both product classifications are influenced by cycles of the economy. In general, when the economy is strong, consumers earn more and spend more on consumer discretionary products. On the other hand, when an economy is contracting, consumers usually earn less and focus their spending more on products essential to their needs. These are known as consumer staples, also referred to as consumer defensive. Economic cycles have a big influence on earnings power and consumer spending in an economy. There are 4 stages of an economic cycle. They are defined as expansion, peak, contraction, and trough. A growing economy expansion to peak is usually characterized by stronger earnings for businesses and consumers. This coincides with more spending. A contracting economy contraction to trough generally has the opposite effect. That is, weaker earnings and less spending. When an economy is growing, it is usually expected that consumers will have more disposable income to spend on discretionary items. They'll be less concerned with saving for tough times. This leads to a greater demand for consumer discretionary products. Alternatively, in a weakening or weak economy, consumers are more likely to forego the purchases of non-essential consumer discretionary products in favor of adding to their savings. These consumers, however, still need to buy consumer staples such as essential and basic household items as toilet paper, paper towels, food, beverages, and gas. Consumer discretionary and economic indicators. There are several economic indicators that help economists to determine the state of an economy. These indicators are also important for predicting trends for the consumer discretionary and consumer staples sectors. GDP. Typically, gross domestic product, GDP, is the number one metric for analyzing an economy. When GDP is growing, it indicates a strengthening economy where people and businesses are willing to spend more. Conversely, when GDP is decreasing, it is an indication of economic contraction and the need for spending prudence. Consumer confidence. Consumer confidence can also be relevant. The consumer confidence indicator can shed light on future consumption and saving behaviors of households. This insight is tied to answers households provide when surveyed about their expected financial circumstances. It's also based on how they feel about economic conditions and unemployment. Typically in a weakening economy, consumer confidence declines and consumers tighten their belts. For example, they may postpone vacations and delay the purchase of products that aren't essential for daily living. These products might include high-end clothing, big-screen televisions, and expensive new cars. The reduced demand for consumer discretionary products is usually a precursor of lower sales for the companies that produce these products. Lower sales can lead to worsening economic conditions and greater economic contraction. Consumer Confidence Index. As of December 2022, the CCI was 108.3, up from 101.4 in November. A level above 100 indicates increasing consumer confidence. This means that they'll most likely save less and instead make major purchases in the following 12 months. Levels below 100 point to a pessimistic outlook for the economy. This may result in greater saving and less spending. 1. Consumer spending. The Bureau of Economic Analysis, BEA, releases a monthly report on personal income and outlays. It includes consumer income and spending figures. The latter is known as Personal Consumption Expenditures, PCE. The report also includes the Personal Consumption Expenditures Price Index, PCE, a gauge of price inflation that is closely followed by the Federal Reserve, Fed. 2. 3. The report documents the spending behavior of consumers. In growth phases, personal income and personal spending tends to increase, leading to more purchases of consumer discretionary products. During contractions, personal income and personal spending are usually lower and spending on consumer discretionary products decreases. Interest rates. Interest rates can be an interesting metric to follow during all types of economic cycles. In general, interest rates rise in growth phases and fall during contractions. The level of interest rates is important for companies that tap the credit markets for business funding. U.S. monetary policy usually seeks to lower interest rates in contractionary phases to provide a business stimulus. Other indicators. Other closely followed indicators that can indicate consumer discretionary trends include the following: retail sales, non-farm payrolls, unemployment levels, labor market hours, labor market earnings, manufacturing activity, services activity, home sales, building construction activity, consumer discretionaries vs. consumer staples. When an economy is growing, many sectors see stock values increase, and this can make equities attractive. The higher values are due to increasing profits and more discretionary consumer income. Consumer discretionaries. Often, when signs of economic growth or recovery begin to appear, consumer discretionary stocks will lead an upward move in stock market prices. Investors who believe a positive spending trend is taking shape may find consumer discretionary stocks a good investment opportunity. However, consumer discretionary companies can be sensitive to changes in economic activity and spending behavior. Consumer staples. When an economy is contracting, investors may find consumer staples stocks a solid investment choice. That's because companies in this sector produce and sell products that consumers need and buy, no matter the economic climate. Consumer staples stocks may even present attractive investment opportunities during a recession. The stock shares of consumer discretionary companies tend to lead a general stock market decline at the beginning of a contraction. Investing in consumer discretionaries. Consumer discretionary ETFs. Many investors like to put their money into sector exchange-traded funds, ETFs, to navigate through different types of economic cycles. ETFs can limit risks with broadened diversification, while allowing for the concentration of investment positions. For the consumer discretionary sector, State Street Global Advisors, SSGA, offers one of the market's top options. The Consumer Discretionary Select Sector Spider Fund, XLY, includes the S&P 500's consumer discretionary stocks. Its top 5 holdings, as of January 2023, were the following. 4. Amazon, AMZN. Tesla, TSLA. Home Depot, HD. Nike, NKE. McDonald's, MCD. For those interested in the consumer staples sector, the SSGA offers the Consumer Staples Select Sector Spider Fund, XLP. It includes the S&P 500's consumer staples stocks. Its top 5 holdings, as of January 2023, were the following. 5. Procter & Gamble, PG. PepsiCo Inc. PEP. Coca-Cola, KO. Costco Wholesale Corp. Cost. Philip Morris International, PM. Consumer discretionary stocks. The demand for consumer discretionary stocks normally increases or decreases as the economy grows or weakens. And since consumers typically purchase non-essential goods when they have discretionary income, anything else that threatens that income, such as lower wages or increasing prices, may also affect stock values. Here are several widely recognized consumer discretionary stocks, in addition to those mentioned above. Toyota Motor Corp. TM. Hilton Worldwide Holdings, HLT. H&R Block, HRB. AutoZone Inc. AZO. Macy's, M. Thor Industries, THO. Consumer discretionary industries. The consumer discretionary sector consists of a variety of industries that can be sensitive to changing economic conditions and bellwethers of consumer spending. The companies included in these industries react and adjust to changes in consumer discretionary income and purchases of non-essential products and services. Industry performance is a useful gauge of trends in consumer spending. Consumer discretionary industries tend to thrive when people feel confident about income and spending is strong. The consumer discretionary sector's manufacturing segment includes automotive, household durable goods, textiles and apparel and leisure equipment. The services segment includes hotels, restaurants and leisure facilities, media production and related services, and consumer retailing and services. Here are the industries in the consumer discretionary sector. Auto components. Automobiles. Distributors. Diversified consumer services. Hotels, restaurants and leisure. Household durables. Internet and direct marketing retail. Leisure products. Multiline retail. Specialty retail. Textiles, apparel and luxury goods. What does consumer discretionary refer to? The term describes products and services that are desirable for consumers, but not essential to their daily living. In other words, rather than having to buy these products because they are necessities, they have the freedom to decide the discretion to purchase them, or not. Consumer discretionary purchasing usually increases when consumers have more money to spend. How do consumer staples relate to consumer discretionaries? While consumer discretionary products are non-essential items that consumers typically can choose to buy when money is plentiful, consumer staples are items that consumers feel are essential to their daily living. These are such things as toilet paper, food, beverages, medicine, toothpaste, and gas. People reduce spending on consumer discretionaries and focus on consumer staples as the economy weakens. What are some examples of consumer discretionary companies? Some of the companies in consumer discretionary industries include Amazon.com Inc., Starbucks, Ford Motor Company, eBay, Tractor Supply Company, McDonald's, The Home Depot, Marriott International, and Domino's Pizza. How can I invest in consumer discretionary companies? You can buy the stocks of companies found in the various industries within the consumer discretionary sector. For convenience and diversification purposes, you can buy a mutual fund that invests in them, such as the Vanguard Consumer Discretionary Index Fund Admiral shares. Additionally, you can purchase an exchange-traded fund that follows the sector, such as the Consumer Discretionary Select Sector SPDR Registered Fund. The bottom line. The term consumer discretionary refers to non-essential products and services that consumers tend to purchase when the economy is strong, consumer confidence is positive, and individuals have discretionary income to spend. The consumer discretionary sector of the economy consists of manufacturing and services industries with consumer discretionary companies. Normally, these companies and their industries are sensitive to changing economic conditions. All right? I am exhausted. I need a break. How about you? Let's make this a video. But, come right back. I am busy preparing something special for your next boring lecture. I have 8 more market sectors to cover, so don't be a lazy asshole. Hee hee hee.